Hi guys. Today we will analyze Lowe's stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, the long-term trend is still neutral. Not much exciting going on here. Support levels are around $210 and $189. The next support level is around $173. Resistance level is around $222. The next resistance level is around $238. In the last month the stock has been trading between $211 and $238 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 4 million. This is a good sign as it is always nice to have a liquid stock. Prices have been falling strongly lately, it is better to avoid new long positions here. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 9% per year, for last 5 years. We see that the average profit margin of the stock has been around 6% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 131% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Lowe's company: bad, average, and good. First scenario. Lowe's will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 3%. Future profit margin would be low, 5%. Future free cash flow to net income rate would be low, 70%. In this case, the fair value of the stock today would be $91. Second scenario. Lowe's will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 6%. Future free cash flow to net income rate would be average, 85%. In this case, the fair value of the stock today would be $136. Third scenario. Lowe's will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 7%. Future profit margin would be high, 7%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $196. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 12.04. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Lowe's, analysts forecast growth rate around 7% per year in next 5 years, and future P/E around 16. Again, I will use 3 different scenarios for Lowe's company: bad, average, and good. First scenario. Lowe's will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 3%. Future P/E would be low, 14. In this case, the fair value of the stock today would be $79. Second scenario. Lowe's will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 17. In this case, the fair value of the stock today would be $115. Third scenario. Lowe's will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 7%. Future PE would be high, 20. In this case, the fair value of the stock today would be $160. As you can see, today the stock is overvalued, $212, even if we expect the company's high performance in future. Lowe's has a medium financial health rating, its profitability is only medium as well. While showing a small growth rate, the stock is expensive at the moment. I may consider buying the stock when the stock drops below $160. Company's strengths. Lowe's is the world's second largest home improvement retailer, behind the Home Depot. The company operates 1,971 home improvement and hardware stores in the US and Canada. The company has expressed a commitment to raising the operating margin over a range of sales scenarios and gaining market share by improving merchandising and broadening its product offering. About 70% of U.S. homes are more than 25 years old and likely in need of upgrades and repairs. The housing market will continue its growth, which will be beneficial for Lowe's. Over the last 30 years, Lowe's has worked hard to make the business less cyclical. More than half of purchases made at Lowe's stores are related to upkeep and replacement, rather than housing turnover. As a large importer of goods, Lowe's has an advantage over smaller retailers on securing supply chain and wide network of holding facilities. Lowe's is a Dividend King with over 50 consecutive years of dividend growth. With a yearly dividend yield of 1.5%, the stock has a reasonable dividend return. Over the past 5 years, Lowe's have increased their dividend an average of 17% per year. Lowe's has a return on assets of 17% and profit margin of 9%. This is amongst the best returns in the industry. Risks. Household incomes and employment are major drivers of Lowe's business. Many building and remodeling projects are discretionary, and consumption may be constrained by slow income growth, and concerns about borrowing. The competitive nature of the retail business is also an issue. While home improvement stores are better insulated from Amazon than most other retailers, items such as high-end faucets and small power tools are very competitive online. Cyclical nature of the home improvement retail industry. The company is not financially healthy enough, and could expect problems in meeting its short-term obligations. Lowe's has negative shareholder equity, which is a more serious situation than a high debt level. The company is expected to show a small growth in revenue. In the coming 5 years, the revenue will grow by 5 to 7% yearly. In the coming 5 years, the earnings per share will grow by 14% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.